All right, we are still on chapter 11. And now we're going to talk about depletion of natural resources. This is when you have acres of trees, you have oil and gas, um, or there's lots of things that nature can give us. And you may purchase some sort of natural resource with the intentions of extracting that natural resources. Okay, we always use units of production when we're depleting natural resources. It's really hard to use anything else other than that. Okay, so um, when they make the journal entry, I wish it was, well, they should have expense there. I wish they would do an accumulated depletion instead of just automatically crediting the natural resource. Okay. I don't really like that. I know the textbook does it. I just wish they'd be consistent because we have accumulated depreciation. We should have an accumulated depletion and accumulated amortization. Sometimes they just don't do it that way. Okay. So let's jump down here. We have an example. And this is Canyon Mining Company has the following 5 costs related to 500 acres of land in Pennsylvania. They have payment for the right to explore for copper deposit, actual exploration cost, 800,000, intangible development cost in digging, constructing the mine shaft, expected cost to restore the land. That is very important because if you've messed the land up, you want to restore the land. And then that gives us a total of that number. I'm not even going to try to say it. Okay. They also have a purchase of excavation equipment for the project. Okay. The company's geologist estimates 1 million tons of copper will be extracted over 3 years. After the copper is removed from the site, the excavation equipment will be sold for an anticipated residual value of 60,000. Okay. And then they tell us how many tons were extracted. Okay. So what did they tell us about this 600,000? It's going to be a little bit different on that one. It has a 3-year life and it has a salvage value of $60,000. Okay. So they're going to come down here. We're going to calculate the depletion. Notice we did not add that 600,000 in, okay, because that's going to be its own expense. Okay. So we take that total, divide it by 1 million tons, and we get this really long number per ton. Okay. I would keep those numbers in your calculator unless it tells you to round. Okay. Leave that in your calculator and then multiply it times the 300 tons that was extracted. Okay. So we will debit depletion expense credit the copper deposit or accumulated depletion for that amount. Okay. They give you a little concept check. You can do that if you want to. They didn't even do anything with that 600,000. So how we would have done that, we would have took, because they shouldn't have even put it in there if they weren't going to make us do anything with it. Okay. So we're going to take the 600,000 and subtract out 60,000, and that will give us 540,000. Divide that by 3 gives us 180,000 a year. Okay. And that will be a depreciation expense. Okay. Not depletion. Okay. Because that's equipment there. Okay. And it's only going to be used for this particular um, copper deposit. It sounds like they said they're going to sell it at the end of the 3 years, and that's how much they're going to get. Okay. All right. Let's talk about, oh, here they are. They're going to do our 600,000 here. And they actually did it different than what I did. So I have to retract what I just said. Okay. So they're also depreciating that with the units of production. That would probably be subjective, but I guess since it's only used for that, I would think it's property, plant, and equipment the way I did it up there. But they're not seeing it that way. So let's do depreciation per ton. We have our 600,000 minus 60,000. We got the exact same 540,000. Divide that by 1,000,000 tons to get 54 cents per ton. They extracted 300,000 tons and multiply it times our rate to get 162,000. Okay. Um, so these assets are a timber tract or a fruit orchard, anything like that. They should be less accumulated depletion, less accumulated depreciation, respectively. They kind of give us a definition: living animals, plants, including trees in the timber tract. All of that they consider biological assets. Okay. Under IFRS, they value them at fair value less any estimated cost to sell. But in the previous video, we talked about how IFRS does let you revalue buildings or things like that, but it still has to be everything within that class. Okay. All right. So now we're going to talk about some intangibles. Okay. We have the useful life of an intangible, could be the legal, regulatory, or contractual provisions often limit the useful life of an intangible asset. Could be useful life, might sometimes be less than the asset's legal life. Okay. Most of the time, intangibles are worth nothing. There's a zero salvage value on those. So there's really nothing to get once it's used up. So you pretty much just amortize it over the useful life, and then you're just going to get rid of it. Okay. Um, the method of amortization should reflect the pattern and use of the asset generating benefits. Okay. Most of the time, they're going to use straight line when it comes to amortization because it's really hard to do double declining balance on that, or even units of production. Okay. So here they give us another example. International Diners Corporation began operations in 2027. Early January, the company purchased the following two intangible assets. So they have a $200,000 franchise, and that is over 10 years. They actually give you that math right down there, which will give us an amortization expense of 20,000. They also have a patent with $50,000 and the legal remaining life of 13. But due to expected technological obsolescence, the company only estimates the useful life of 8. They're going to use the 8, not the 13, okay? Because that's how long it's going to be useful for. And that's where they get the 6250, okay? So I really wish they wouldn't credit the asset. I wish they would do accumulated amortization for the franchise, accumulated amortization for the patent, but that's the way they do it, okay? Don't do that for property, plant, and equipment. It will be wrong. Okay. And so then they go on to tell us that IDC decided to sell the patent on December 31st, 2031. Okay. 5 years after the acquisition for 21,000. Okay. So where's our patent? Our patent had started at 50,000. And then we are going to, first thing they did, I'm really proud of them. First thing they did was catch the amortization up. Okay. Um, it did record it for each of the 4 years, 27, 28, 29, and 30. They are selling it in 31. So we need that fifth year of depreciation. Okay, so kind of come back up here. That was the patent. So the 6250 multiplied times 5, it means they have expensed or amortized $31,250. The patent had 50,000 in it, and they credited the patent for 5 years of of that asset. That gives us, that patent had a book value of $18,750. That's our book value. Okay. I guess the good thing about them not using accumulated amortization is you don't have to close that one out. Okay. The book value in the patent is $18,750, and they said they are going to sell it for $21,000. So 21,000 minus the 18,750 gives us a gain of 2250. Okay. Remember, you can debit the cash, figure out how much is in the patent, and credit that. If you need that credit, it's going to be a gain. If you needed a debit, it would have been a loss. Okay. Moving right along, we are going to talk about software development cost. And this can be kind of confusing right there. So we're just going to jump on over and work through a problem. I think it will help. We are looking at amortization of software development cost, either the percentage of revenue method or the straight line method. Okay. So let's come over here, and we have Astro Corporation develops computer software graphics programs for sale. A new development project started in 2026, reached the point of technological feasibility June 30th, 2027. That is a very important date. So they tell you cost in 2027 were as follows. Prior to June 30th, 2027, that is all going to be expensed. Okay, because this is like research and development, all of that gets expensed. Once it became technologically feasible, then we can start capitalizing what we have. So we were able to capitalize that 800,000. Okay. So they give us some information here. They tell us what the sales in 2028 will be, and then the sales from 29 through 31, and then the total. That 10,000 is just these two added together. Okay, the 3 million is year one. That's what we're calculating. Okay, so we are going to, the first thing they wanted to do, what is going to be expensed and what's capitalized. We've already done that. I told you 1.2 million gets expensed. Okay, so then we're going to come over here. We're going to calculate the percentage of revenue method. Okay, they took the revenue from that 3 million that was from 2028, and they could have just put 10 million right here. They didn't have to add the two together. They could have just put 10 million, and divide that out. That means 30%, the percentage of revenue method, then multiply that times the 800,000, because that's all that we capitalized, gives us 240,000. So now let's look at the straight line. Okay. If we look at straight line and we take the 800,000 and divide it by 4 years, or multiply it times 25%, is exactly the same thing. You get 200,000. Okay. They want you to take the higher of the two. You're probably thinking, oh, that's the first time in GAAP they've ever said take the higher of the two. Okay. When you take more right here, we're calculating the amortization. So we're actually taking more expense. So we're still following the conservatism policy. Okay. So by taking the greater of the two, we're just looking at the greater of two expenses. So conservatism is still a thing. And we will make the journal entry: debit amortization expense, credit software development cost, or accumulated amortization for the software cost. Okay. All right. This is not IFRT, not international. I know some of y'all are in my international accounting class right now, but I'm going to jump on so we don't make these videos too long. Okay. So now we're going to talk about indefinite life intangibles that are not subject to amortization. Okay. They're not, the things that are not subjected to amortization, we are going to look for impairment on them. Okay. The examples that can be indefinite life is goodwill, trademarks, and trade names. Okay. So I am going to stop a little minute right here for the intangibles. US GAAP prohibits any revaluation of intangibles, but IFRS does allow it. Okay. I got lots of specification here, but remember, if they do revalue, all assets within that class have to be revalued. Goodwill cannot be revalued. There is no way to calculate a revaluation on goodwill, and you actually can't even record goodwill. You may be the company that created the goodwill, but you can't record goodwill. Whoever buys your company can record goodwill. Okay, that's the only way goodwill gets revalued in a complete total purchase of a company. Okay, so keep that one in mind. And we have a little concept check here. Then we are moving on to changes in estimates. Okay, I've talked about this before. When you are depreciating, you are looking at the cost, which is a number we know. We look at salvage value and we look at estimated life. We don't really know. Those are estimates. We do not know if that is a real number or not. Okay. It could be different. It's better than not having an estimate at all. Okay. When we change the estimates, we go forward. We don't go backwards, okay? Because when we made the estimate, we made the best decision with the information we had right now, okay? So we're only going to go forward. There could be a disclosure note that should describe the effect and what it does to net income and related per share amounts, okay? So here we have a change in estimate. This is very similar to the one that we had worked earlier, I believe. Yes, it is almost identical. So we have the same let's have the same piece of machine, 250,000, residual value 40,000, service life is 5 years. Okay. So then they get to year 2, 2 years later, and the company is going to revise the estimate as follows: service life from a total of 5 years to 8. You have to be very careful. That's usually it's definitely where they would confuse me. You might think you're going to go and divide this by 8, but you're really not, because you've already depreciated it 2 years. So I kind of came down here where they had the 6 and took 8 minus 2 gives us 6 more years. Okay. Um, Remember that accumulated depreciation. If we depreciated it for 2 years, we have 84,000 in there. That's where that calculation is right there. So basically what we're going to do is we're kind of like pause for a second. We're going to figure out what the accumulated depreciation is and what is the book value. That book value is what we will use going forward on our estimate. Okay. So that machine was 250,000. Here's our 84,000, gives us that book value of 166. Okay. Did they revise oh yes, they did. They revised the residual value as well. Okay. That kind of makes sense. It's going to last longer, but it's going to have less salvage value. Okay. So we take the 166 minus the 22,000 and divide that by 6. And that is what will give us our new depreciation. Notice there is not a journal entry going backwards here. It is only going forwards. Okay. There is one you can work on your own. They give us a little disclosure here from Oracle, kind of showing here's our change in estimate they had. How does it affect our financial statements? Okay. And the last thing we're going to talk about in this video is changes in methods. So change in depreciation, amortization, or depletion method. So going from straight line to double declining, something like that. That will be going backward. So prospectively means going backward. I think I spelled it out somewhere. Okay. Going backwards. Okay. So they give us an example here. And this is a really good one, mainly because it's almost identical to what we've already done. Okay. But they're looking at, they started with that same machine, same life, and the residual value was 30,000. Okay. That didn't really change that year one and year two depreciation. I think it was 40,000 and the problem we worked, but it didn't really change that first year because we don't take the salvage value out on the front end of double declining balance. Okay. So what they're going to do, they did double declining balance for 2 years. Okay. And this actually happens quite frequently because they get a lot of depreciation in that year two, those first years. And then they're going to switch to straight line. Then they'll switch to straight line for the remaining 3 years. Okay. So that accumulated depreciation account, I'm going to draw that T account out. It had 100K in it and 60K. Okay. That had 160,000K in the accumulated depreciation. So 250 minus the 160 gives us 90,000 as our new book value. Okay. Then we're going to subtract out that residual value. They do that right here. This 90,000 is what I just calculated over here. Subtract that residual value out. We've got depreciable base of 60,000. Divide that by 3 years, and that gives us 20,000 in new annual depreciation. Okay. Here is a disclosure where they did a change in depreciation method, just telling them this is what we changed to. Okay. We're almost done, y'all. There's a quick little concept check if you want to do that one. Then we're going to talk about errors when you make a mistake. When I was studying for the CPA exam, they kind of talked about it like non-GAAP to GAAP. Okay, that's an error. Okay, an error is also looked at retrospectively. I think I said something wrong. Did I put backwards up here on prospectively? I did, and I did not mean to do that. That's forward. Okay, sorry about that. I just when I saw that backwards there, I was like, I think I wrote that wrong. Okay. So retrospectively, that does mean backwards. Okay. And we would call that a prior period adjustment. Okay. And the example they give us right here is they had a patent. They discovered an error when they successfully defended their patent, and that is capitalized. If you go to court over your patent and your legal fees and you successfully defended that patent, then you get to capitalize that amount because basically they said your patent is still in control and these are the fees that you get to add into it. Okay. They expensed it to legal fee expense, but it should have been capitalized and amortized over 5 years remaining life. We found it 2 years later. Okay. So they had that asset, should have been 300,000 divided by 5 years. They should have amortized it 60,000 a year. Multiply that times 2. So 120,000 should really stay in expense. So we're really not going to do anything with that. We're going to take the 300,000 minus the 120 and we get this 180,000. We're going to debit patent and credit retained earnings because this does go backwards. Okay. It does go backwards. It is retrospective. So we want to make sure that we are telling our readers just that. Okay. And that is all for this video. I will see you in the next one.